Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, as markets brace for the potential impact of the ongoing US government shutdown, investors, of course, are keeping a close eye on how long this shutdown might last and the political dynamics at play behind the scenes. Now, how should investors be navigating the shutdown and is there something to worry about? To help answer that and more, I'm joined today by Raymond Cheng, who's our CIO for North Asia, who will help us discuss the question at hand as well as where he sees potential opportunities amid this economic and policy uncertainty. So, welcome, Raymond, and I guess let's jump right into the obvious question: the government shutdown in the U.S. What are your expectations around the shutdown?
Sure, Manpreet. Our base case is a brief US government shutdown, which is likely to have limited market implications. The duration of the shutdown does matter here. Based on historical data, a brief US government shutdown is likely to have limited impact on the economy and markets. However, a prolonged shutdown lasting beyond 2 to 3 weeks' time remains a key risk, given the Democrats want to use the opportunity to undo the planned ending of healthcare subsidies under Obamacare by the end of the year. Now, our base case is the Trump administration will likely be reluctant to hand over to the Democrats a win over the politically sensitive issue of health insurance ahead of next year's midterm elections. Therefore, Republicans will likely agree on at least a partial extension of healthcare subsidies, helping to quickly end the government shutdown. The risks to watch out for are if President Trump will permanently lay off federal workers and the magnitude of such layoff.
Thanks, Raymond. Now, the interesting thing is, despite the shutdown, equity markets seem pretty unfazed. We've seen major benchmarks actually hitting record highs over the past week. So, how do you see equity markets playing out in this context, and do you see any opportunities?
Yes, markets seem to have priced a brief shutdown scenario, in which case we see limited impacts on growth and corporate earnings, and hence on US equities as well. However, in a prolonged shutdown scenario, the uncertainty could lead to rising volatility and fears about consumer spending weakness. This could impact growth expectations and the US equities earnings outlook, resulting in a pullback. The shutdown coincides with the US equity market investor positioning that is now sitting at quite bullish levels, raising the risk that it could trigger a short-term equity market pullback. We would use any of this short-term equity market drawdown caused by the government shutdown to add to our two preferred equity market exposures, the US and Asia ex-Japan. Now, the structural AI-driven earnings growth story driving the tech sector in the US, Europe, and China will remain in place, regardless of how long the US government shutdown lasts. In addition, we see upside in the US healthcare equity sector. The sector has reacted quite favorably of late after major pharmaceutical companies reached an agreement with the White House on lowering US drug prices. Besides, the 100% tariff on imported drugs into the US can further strengthen the drug-making supply chain of the US and protect domestic production as well.
What about bond yields? I mean, do you expect much of a reaction there to the shutdown?
Now, government bond yields have historically declined during government shutdowns. A government shutdown poses significant challenges, such as the pausing of non-essential services, which would impede the release of crucial data that is necessary for economists to evaluate macroeconomic developments. Concurrently, a surge in non-essential federal layoffs and suspension of government functions would negatively impact economic activity as well, raising the risk of an economic slowdown and potentially leading to lower bond yields. However, the impact on growth does depend on the scope and duration of the shutdown. We anticipate a short-term shutdown is unlikely to trigger US credit rating downgrade, as the hit on growth should be viewed as marginal and transitory. We expect yields to stay anchored in the near term, with the benchmark 10-year US government bond yield to stay within our 3-month target range of 4 to 4.25%. We continue to reduce exposure to longer maturity bonds and prefer 5 to 7-year maturity profiles for bond portfolios.
All right, let's shift to currency markets. So against this backdrop, we discussed stocks, bonds, but what's your outlook on the US dollar? I know we expect a weak dollar, but I guess the related question is which currency do you think would benefit the most on the other side?
The US dollar backdrop remains quite fragile here. A scenario where no deal is reached between President Trump and Congress in the coming days could imply a prolonged US government shutdown, similar to what happened during Trump's first term. This would imply the US dollar index is likely to slide towards support at around 97.1. Now, on the other hand, we expect the Japanese yen to outperform given the safe haven status. Markets are now pricing in just a 50% chance of a Bank of Japan rate hike this month, based upon the messaging from the central bank, as well as the Tenkan survey. The LDP leadership candidates avoided taking a strong stance regarding monetary policy, which signals lead to resistance to potential tightening from the Bank of Japan. Meanwhile, we are expecting the Fed to cut rates here in the US by 25 bips in the upcoming FOMC meeting, given continued weakness in the US labor market, which is evidenced by the private sector payrolls, which fell by 32,000 in the month of September, which marked the steepest drop since March 2024.
Thanks, Raymond. One final question on commodities. I guess amidst all this uncertainty, it's natural to look towards gold, but gold prices have gone up a lot in recent weeks. Do you still see it as a favorable hedge in this environment?
Yeah, in general, precious metals did perform well during past U.S. government shutdowns. Gold, in particular, will also be benefiting from structural demand from central banks amid elevated global policy uncertainty. Now, we view gold mining stocks as a tactical opportunity against this backdrop. The sector is seeing rising profit margins as the gold rally has driven realized prices far above the all-in production cost, which stayed below $2,000 per ounce. Silver has also done well, surging 64% year to date. But silver is an industrial metal and hence more susceptible to any concerns about the global economic cycle. Hence, we are wary of chasing the rally in silver at current levels. We will be more comfortable establishing exposures should prices fall to around $40 per ounce. So meanwhile, we remain bullish on gold over the medium to long term.
All right. Well, thanks, Raymond. I think we'll bring today's conversation to an end on that note. Thank you for taking the time to speak to us today. If I can summarize the top takeaways from today's conversation. Number one, U.S. government shutdown risk, yes, but if we do see a pullback, we'd be happy to add to our preferred regions of the U.S. and Asia ex-Japan equities in particular. Second is that from the currency market, the dollar we think is still set to weaken, but the Japanese yen could be one of the biggest potential beneficiaries. And third, of course, is gold. We continue to see it as attractive over the medium term, but we also see an attractive tactical opportunity on gold mining equities. So with that, we'll bring the podcast to an end. Thank you very much for listening in today. Please do like and subscribe if you enjoyed today's conversation, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.